Before we get into the capital markets and recapping, our thoughts and prayers are with the Israeli people, first and foremost, those that are grieving the loss of loved ones, and then as they go on their campaign to defend their country. So kind of moving on, my name is Jason Staley. For those that don't know, I'm the Chief Investment Officer and partner of the firm. And with me is my Manager of Research and Due Diligence, Mike Divens. Mike, good morning.
Good morning, Jason.
Certainly there's no shortage of things to talk about, but I think that as we sat down as an investment team to discuss, I think the two themes that we came up with were kind of somewhat in conflict with one another. Interest rates continue to rise,
Yes.
and artificial intelligence is dominating equity markets. So as that kind of as the backdrop, maybe kind of give a quick summary of what happened in the rate market, and then we'll talk about how that's kind of affected most of the equity markets, except for mega cap technology stocks, which don't seem to be affected by interest rates or inflation.
Very plainly, it's no surprise. Interest rates have been rising now for 2.5 years. And obviously in 2022, markets reacted, we believe, appropriately. Interest rates going up, you can finally get some return on bonds from coupons, and equity, no need to take the added risk in the equity market. Well, in our early conversations in 2023 and even late 2022, it was, what do we think is going to happen? And I'm not sure if we thought that 7 stocks would dominate and pull the S&P up 36, 7, 8%, whatever it was at its highs when you look at those growth companies. So to that point with interest rates is what you saw in the third quarter was the belief that interest rates, they did go up. I mean, the 10-year almost hit 5%. Mm-hmm. And you see almost a kind of U in the yield curve now, where before it was just inverted.
When Mike's talking about the U, kind of for a visual, if you looked at like the 3-month treasury, I think it's had a yield of like 5.4%. Mm-hmm. And then you had kind of the 10-year, which almost touched 5%. Mm-hmm. As that U shape becomes more of a straight line, and then you get the uninverting of the yield curve. As Mike said, typically when you have an inverted yield curve and it becomes uninverted, that means that a recession is somewhat imminent. Most Federal Reserves and central banks control the short end of the curve. And we define the short end of the curve, let's just say 3 months to 2 years in terms of maturity. The US Federal Reserve, by and large, kind of controls that part of the market. The longer end of the yield curve, that is more determined by the market and investors. So the investors are taking a look at the macroeconomic background and saying, like, you know what, Mr. Market, I'm demanding more compensation, right? I want more yield. And I think that for the first time, you've seen that push-pull of, hey, you had this arbitrary, I could lock in the 10-year treasury at 4.9% for 10 years on an annualized basis, or I could take the 2-year treasury yield and get 5.11%. And it's this trade-off of, do you lock in yields for the short term, or do you look longer out on the curve? And I think that's kind of a big discussion of ours, right?
When we're talking about longer end of the curve, what we're really talking about from an investment standpoint is longer term bonds, right? What can we invest in? We've consistently, I think, been very good in saying we believe in lengthening the duration, which is just the years out of the bonds, basically, in your portfolios.
Right.
And while yields have continued to go up this year, which wasn't unsurprising, and there may still be one more rate hike, we believe that, to Jason's point earlier, your risk premium to go and get equities now is very, very high. No one's in favor of the Fed destroying what 2023 has brought so far. Whether or not they hike or not, we do believe that they need to do what's right for the economy in the longer term. Why not just take that 6-month treasury or this 9-month CD at 5.5 or 5.6 and just, to Jason's point earlier, we were talking was bury your head in the sand, don't worry about it. Not a bad strategy. However, we do believe that you might miss out, or you might have some reinvestment risk if, gosh forbid, anything else happens that causes yields to drive down, and you're going to miss out on some areas that we believe is really good in the longer term end of the bond market. And we're not wavering on that, no matter what happens. I think later in the year,
there are these exogenous events that you cannot predict, and in those cases, those those short-term Treasury bills are going to be fine. The money market funds aren't going to move. The bank certificate deposits, as long as you're under $250,000 of exposure, making compliance very happy right now.
Yeah, right.
There's a lot of things, but assuming you're under all of the FDIC coverages, those bank CDs are going to be fine.
Yep.
But they're not going to appreciate. But if you take 2022 out of the equation, your intermediate term bonds, right? And we're never going to go out and buy the 20-year or 30-year Treasury. Way too much volatility for us to take kind of long-term risk. But in the intermediate part of the curve, you're seeing the best yields we've seen in 15 to 20 years. From a valuation standpoint, if you're just looking at it, investment grade fixed income look substantially more attractive than stock. The earnings yield on the S&P 500 isn't terribly better than the 6-month or the 3-month Treasury bill. And I think that when you look at the fixed income, and the reason that we continue to be very much in favor of adding to core fixed income, is that you're locking in these yields for a significantly greater amount of time than these short-term Treasury bills. And then on top of it, and what we really like from a construction standpoint, is if risk does fly off the table, bonds have this proverbial seesaw where prices go up and yields go down. It's not to say that we don't have any exposure to shorter duration bonds. We do. But for longer term, the more strategic asset allocation for our clients, so this is an opportunity that comes around on the core fixed income side, every 15 to 20 years. Absolutely. And so that's what we're doing. That's what we're doing in client portfolios. Transitioning now to what's playing out in equity markets. Two of the broad asset classes were positive in the third quarter. The Bloomberg Commodity Index, driven almost entirely by the rise in energy price, and then the 3-month U.S. Treasury note. As yields go up, you don't have any interest rate sensitivity. That would make sense that you did well. Everything else was negative. So we've got higher interest rates putting pressure on bonds. The short end of the curve looks very attractive. However, kind of zooming out, we kind of like the core exposure. The S&P 500 is up 13%. International developed stocks up 7%. So I think we've been to recap. We've liked international developed stocks. We still think that they're undervalued. They've done a very good job in the portfolio. Second best performing broad asset class behind, you guessed it, the S&P 500. But really, Mike, it's really not the S&P 500. It's more like the S&P 7.
Right.
And in particular, people have been calling it the Magnificent 7. Talk a little bit about artificial intelligence and why that may or may not, at least for now, seems to be impervious to the pressures of interest rates and inflation.
We have one that makes all the chips that everyone wants, and then the other 6 that everyone thinks can capitalize on. That they can buy the chips and somehow still be profitable and then be able to charge whatever the heck they want.
So really, the top 7 stocks, it's Apple, it's Amazon, it's Google, so Google Class A, Google Class B, it's Tesla, it's Facebook, or now called Meta.
These stocks are up anywhere from 30 to, I don't even want to try to guess what NVIDIA is up today.
Like 100.
100, let's just say 30% to 100%. And then you have some others that are kind of on the outskirts. And to Jason's point, while we say it's 7, you could argue it's 10, it's 15, but it's this driver of AI. And we're not saying AI is a bad thing at all. But one of the things that these 7 companies do have in common, and we can include Tesla now that it's in the S&P, is it's profitable. One, they can afford these AI chips, going back to the AI. But the other thing too is kind of going back to the first part of the conversation is, a reason that tech stocks and biotechs and small and mid caps don't do so well when the rates are rising is they have to borrow. And now it's more expensive to borrow than it has been in 15 years.
Sure.
And so you've had this kind of tech boom since, you could say 2016, but I'll even go back to 2012, 2013, when it's basically been free to borrow. Well, the reason these 7 stocks may act differently, along with the AI and everything else, is they don't have to borrow as much. They have large cash flows.
To your point, I think it's going to come into focus as like the easy earning comps are over, right?
Yes.
The expectations were very low. They're going to continue to get higher, both in the aggregate on the future and then based off of the comps from as they get into. So we wrap up the third quarter, get into the fourth quarter, the first quarter, when you're comparing against 2023 results, which were very, very good, right? So coming off of kind of beating those low expectations. And then I just think investors are going to look and they're going to start to demand to see increased profitability and
Absolutely.
margins. We're not here to question the technology, but what we're here to say is at a certain point, and we use Tesla as an example, at a certain point, you have to be able to show that you're profitable.
Absolutely.
And Tesla has, to varying degrees, been able to show that they're profitable. So I think kind of transitioning to like the others, right? So there's like in the equity markets, it's been U.S. equities up 13%, international developed up 7%.
Absolutely.
International developed still looks very attractive. We've talked a lot about it, but I think on the U.S. side, you're starting to be able to see small cap and mid cap stocks trading at 12 times earnings forward on the forward side, and that has historically been a very good time to buy them. You know, they are more affected by interest rates, right? They're just to Mike's point. I think it's an important one. The way that your small cap or mid cap company funds itself is a lot different than Microsoft. So what we're not saying is that the performance of small caps, while we think is somewhat oversold, you can understand why they come under a little bit more pressure as interest rates rise. But looking forward, buying them at these multiples looks incredibly attractive. When you pull down 7.5% in a quarter, like publicly listed real estate did, and the Russell 2000 trades down 5%, it shows the level of interest rate sensitivity. Yes. But if you do believe that interest rates are we're in the 8th or 9th inning of them being raised, then you have to start to think, well, what's our next play?
Yeah, it's kind of the same point we had with investing in intermediate term bonds when we did, right? It was, hey, we might be a little early or we might be in the, to Jason's point, 8th or 9th inning, but we want to be on the front end of this. We can't tell what's going to happen tomorrow down the road. All we can do is put the portfolio in the best position possible. And if we believe in small and mid, and we do, then there is really no better time to have them in the portfolio. I think is the simplest way to say it.
So there's a reason that the S&P rallied the way that it did, but also kind of the factors that affected the free money, the low interest rates. I think the one consistent thing we've seen out of this Federal Reserve is they have said, we're not going back to that.
Yes.
Like we're not going back to zero interest rate policy. We've seen what that can do. So it's going to be some combination of higher for longer and probably a little bit more inflation than that 2% target. Certainly a lot to digest. I think we want to end it with this comment, which is, first, if you're feeling uneasy about your portfolio, it's not unwarranted. We live in really interesting times in terms of what's going on in the world geopolitically, what's going on with interest rates. If you're uneasy about what's going on in your portfolio, please reach out to your Schneider Downs advisor. We'd love to have a conversation with you. And then on the flip side of that, we're going to be reaching out to you, check in, make sure everything's okay, set up those quarterly meetings, and hopefully, use this video, the quarterly letter, as a way to walk through the portfolio so that you're able to know kind of the 3 things that make up the foundation. Do you know what you own, why you own it, and how it fits into your portfolio and your financial plan?